He is sitting at a kitchen table. A loan offer is lying in front of him. 6 months ago, that number looked manageable. Now he just stares at it. Then he sets it aside. He does not sign. Not yet. Earlier that week, someone else opened the same banking app and smiled at a few extra dollars in a savings account. Same bank, same week, completely different feeling. Two people, same bank, same week. One hesitates, one smiles. That is what interest does.
The same force can reward you for waiting and punish you for borrowing. It can make saving feel smarter while making homes, cars, and business plans harder to afford. Interest is not just an extra fee, it is the price of money over time. That idea sounds simple, but it explains almost everything. If you borrow money today instead of earning it first, you are using someone else's money before you have your own. That has a cost. And if you let someone else use your money for a while, you are giving up the chance to use it yourself. That can earn you a reward. Interest is what turns time into a price. Imagine money like a tool. If you lend someone your ladder, you cannot use it while they have it. If they want it for a week, that is one thing. If they want it for a year, that is something else. Money works the same way, except it matters more, because money can be turned into almost anything. It can buy food, pay rent, build a company, or keep someone afloat during a crisis. That is why access to money has value all by itself.
Once that clicks, the rest becomes much easier to understand. If a bank pays you interest on your savings, the bank is paying for the right to use your money for a while. If a bank charges you interest on a loan, you are paying for the right to use the bank's money before you have earned it. The direction changes, but the logic stays the same. Banks sit right in the middle of this system. Millions of people deposit money. The bank gathers all of it into one large pool. Then it lends that pool out to people buying homes, businesses buying equipment, or families covering large expenses. The bank usually pays savers less interest than it charges borrowers. That difference is part of how the bank makes money. When people say banks make money from money, this is one of the clearest examples.
But not all interest rates are the same. Think about it this way. Lending money to a close friend for 1 week is one thing. Lending it to a stranger for 10 years is something completely different. Lenders think the same way, and they price that difference into the rate. How long the money is tied up changes the picture. So does the risk of not getting it back. If prices rise while the money is out on loan, the lender gets back the same number but less purchasing power. Every one of those changes the price of borrowing. This is where many people miss something important. The number printed on the loan contract or the savings account is only part of the story. That is the nominal interest rate, the visible number. What really matters is what happens after inflation. If your savings account pays 3%, but prices rise by 5%, your account balance grows while your purchasing power shrinks. On paper, you earned money. In real life, you lost ground. And this does not happen somewhere far away. It happens every day. By this point, interest stops looking like a fee. It starts looking like something much bigger. Interest is not just about money. It is about timing, risk, and power. Then there is compound interest, which is where the system becomes truly powerful. If you earn interest on your original money, that is simple. If you later earn interest on the interest you already earned, that is compound interest, growth on top of growth. Put away $1,000 and earn 5%. After the first year, you made $50. In the second year, you are not earning 5% on $1,000 anymore. You are earning it on $1,050. That difference looks tiny. Give it enough time and it stops looking tiny. That is why someone who starts saving at 25 can end up ahead of someone who starts at 40, even if the second person saves much more. Time does not just help money grow, time helps growth grow. The same force can work against you. Credit card debt is one of the clearest examples. If interest keeps being added to a balance you haven't paid off and new interest is charged on top of old interest, the debt can grow much faster than people expect. That is why compound interest is often your best financial ally or your worst financial enemy. It depends entirely on which side of the contract you are standing, and you do not have to look far to see it.
A family with cash in a high-yield savings account starts earning more when rates rise. A first-time home buyer suddenly finds that the same apartment now comes with a much higher monthly payment because the mortgage rate increased. A small business that wanted to borrow for a new machine decides to wait because the loan is no longer cheap enough to justify the risk. The numbers changed, but what really changed was behavior. And when enough people make the same decision at the same time, the whole economy shifts. That is not theory, it has happened before. Imagine trying to buy a house in 1981. Mortgage rates in the United States had climbed above 18%. For many families, a home suddenly moved out of reach. That was not an accident. It was a deliberate move by the central bank to make borrowing painful enough to slow the entire economy. More recently, after the global financial crisis, and again during the pandemic era, many central banks pushed rates very low to make borrowing easier and keep the economy moving. Cheap money helped support spending and investment, but it also encouraged more debt, more risk-taking, and later, more inflation pressure.
This leads to the bigger layer, the policy rate, often called the central bank rate or benchmark rate. Imagine a dial at the center of the financial system. Turn it up and borrowing gets more expensive almost everywhere. Mortgages, car loans, business credit. Turn it down and money starts moving more freely. That dial is the policy rate. It is not the exact rate on your mortgage or savings account. It helps set the tone for the whole financial system. You can think of it as the rhythm of money. Cheap money speeds decisions. Expensive money delays them. Central banks use this because they are always trying to balance two things that constantly pull against each other: stable prices and a healthy economy. If inflation rises too fast, they may raise rates to cool demand. If the economy weakens badly, they may lower rates to encourage borrowing and activity. That is why interest is not just a personal finance topic, it is one of the main control levers of the modern economy. And that is why higher rates create winners and losers at the same time. Savers may finally earn something meaningful again. Borrowers may suddenly feel trapped. Governments with large debts may face heavier interest costs. Companies that relied on cheap loans may stop expanding. Stocks and real estate can also react because when money is cheap, investors often take more risk. When money is expensive, they usually become more cautious.
At the core, the same thing happens in every version of this story. Interest changes choices. It decides whether waiting feels smart or painful. It changes whether buying now seems possible or reckless. It shapes how much risk people take, how fast businesses grow, and how much pressure governments feel. It is not just a number in the background. It is one of the invisible forces organizing the entire economy. And for you, that means every major financial decision becomes clearer once you stop asking only how much something costs and start asking what the interest is doing underneath it. A savings account, a mortgage, a credit card, even the price of homes around you, they all make more sense through that one lens. Once you see that, the whole system stops looking random. That is why people who understand interest seem calmer when rates move. They are not seeing chaos, they are seeing the cost of time shift in real time. If this helped you, subscribe for more clear explanations like this, and tell me in the comments, right now, do higher interest rates feel more like an opportunity to save or a barrier to buy?